Welcome to the deep dive. We are jumping straight into, well, one of the most perplexing stories in the financial world right now.
Yeah.
We're talking about the massive pharmaceutical giant, Bristol-Myers Squibb, or BMY. It's kind of the ultimate investment paradox, isn't it? They're facing this potentially catastrophic patent cliff. Yet for the past 9 months, their management team seems to have been executing almost flawlessly, raising guidance, stabilizing revenue, but the stock price, it's just completely frozen. Stock.
It is genuinely a head scratcher. Yeah. And to really understand this disconnect, we dove into a serious stack of sources. We pulled the company's earnings reports Q1 through Q3 of 2025. And crucially, we leaned heavily on a detailed research report from Compascope. That report gives us a really clear factor-by-factor scorecard on, exactly how successful management has actually been lately.
Okay, so our mission today, for you, the listener, is to try and cut through all that noise. We are going to isolate BMY's key risk factors, really measure their recent stellar execution, then try to understand precisely why the market seems to be refusing to acknowledge that success, and finally look at the tangible odds of a major valuation re-rate happening, say, in the next 12 months. Let's unpack this puzzle.
Right. So before we start celebrating any execution wins, I think we really have to appreciate the sheer size of the mountain BMY is climbing here. That Compascope report identified, 10 factors, but 3 really stand out as absolutely critical for BMY's future.
Yeah, factor 1, and it's the one that casts the longest shadow, definitely the loss of exclusivity, the LOE. This is that huge impending revenue cliff from massive blockbusters. We're talking Revlimid, expiring basically now 2025, and then Eliquis, which is looking like 2027 to 2028. I mean, this bucket of revenue at risk, it's well over $20 billion in cumulative sales. Just creates a massive hole they need to fill. A huge hole.
Yeah.
And factor 2 directly addresses how they plan to fill it. Pipeline success. BMY is highly reliant on getting new high-impact assets off the ground. We're talking potential blockbusters like milvexian for cardiovascular risk, iberdomide in oncology, and also their emerging radiotherapeutics platform. These have to replace that LOE revenue.
And factor 3 zooms in on one specific new asset, Cobenfy for schizophrenia. Management has put a really big target on this launch. They're projecting it to reach a peak of $5 billion annually by 2033. Getting that right is pretty much mandatory for validating their whole neurology strategy.
Yeah. Now, for the genuinely surprising part, when you dig into the sources, the execution scorecard for the first 3 quarters of 2025 against these massive threats, it's actually been overwhelmingly positive. Let's start with the biggest risk, managing that LOE cliff.
Yeah, what's fascinating here, based on the reports, is that management delivered what Compascope called better than planned erosion. This is so critical because it buys them time, right? Revlimid sales, for instance, were so resilient that BMY actually revised its full year 2025 sales outlook upward. Not once, but twice. It's now tracking at approximately $3 billion for the full year. That's much better than feared.
Hold on a sec, though. Is that genuine operational success, or is it just, the company setting the bar really low initially so they could easily clear it? Is that a real win?
Well, look, even if you account for potentially conservative initial guidance, mitigating the steepness of that cliff is still a huge operational win. They're managing the supply chain, the pricing dynamics, seemingly better than expected. And it's not just Revlimid. Eliquis sales also saw a pretty big rebound in Q3, up 29%. That was driven by some favorable Part D redesign benefits flowing through. Bottom line, they are delaying the inevitable drop-off, and that time is absolutely invaluable for them.
That is true. Time is capital in this industry, especially when you need a pipeline to mature. So what about replacing that future revenue through business development, through deals?
Execution there is also scored as positive. We saw a really strong targeted cadence of deals. They secured that BioNTech immuno-oncology partnership, the Philochem Radio-Pharma Alliance, and also the Orbital Therapeutics acquisition for in vivo CAR T technology. These deals seem to aggressively bolster the pipeline exactly where they need it most, kind of late decade, post-cliff.
Okay, and the crucial new launch, Cobenfy. How's that tracking?
That one is delivering a steady build. The sales have increased sequentially every quarter, went from $27 million in Q1, then $35 million in Q2, and hit $43 million in Q3. And management seems confidently focused on the monotherapy opportunity. They're demonstrating commitment, even though they had that recent setback in the adjunctive schizophrenia study.
Right, can't forget about that. And we also can't ignore their financial health in all this.
Yeah. No, and the cost management looks robust. They launched that $2 billion strategic productivity program. It seems on track to deliver $1 billion in net savings for this fiscal year, 2025. That creates a really crucial margin cushion, which, essentially helps fund those new business development deals we just talked about.
Okay, so if we step back and look at our sources,
Hmm.
management has actively, you could say, out-executed its own key watch list over 3 quarters. They've repeatedly raised revenue guidance. They're building their future pipeline. Yet the stock is just frozen in place. It really is maddening. What specifically is the market missing here? Or maybe what is it seeing that outweighs this execution?
Well, the disconnect is profound. You look at the valuation. BMY trades at roughly 7.4 times forward PE. I mean, that's incredibly low historically and way below peers. And the stock is down, what, about 20% year to date, lagging pretty much everything. It feels like operational good news is just being completely ignored, overpowered by these big structural overhangs.
7.4 times forward PE. Just to put that in plain terms for you, the listener, the market is basically pricing this company like it has almost no future growth potential, zero, or worse. Okay, let's unpack these key overhangs that are apparently suppressing that multiple. Overhang number one seems to be just the raw valuation math itself.
Exactly. Patent cliffs dominate valuation. It's simple, but brutal. The market applies deep, deep discounts to any cash flows projected past 2028. That's when Opdivo's U.S. exclusivity is set to end, piling on top of the existing Eliquis and Revlimid risks. The gap between the current earnings, which are still huge, by the way, and the uncertain future replacement revenue is just perceived as too wide. Those new replacement assets, like Milvexian, they won't meaningfully inflect, won't really start kicking in big revenue until maybe 2027 to 2029. And the market is pricing the risk of that huge vacuum today.
Right, and that risk perception, I imagine, is only amplified by some really large one-off accounting charges that just destroy confidence in the reported numbers.
That's overhang too, accounting noise. And yeah, 2025 has been incredibly messy on that front. In Q2, we saw that big $1.50 per share BioNTech upfront charge hit the P&L. Then in Q3, they logged a truly massive $6.1 billion impairment charge, just huge. And that was largely related to the Corona intangibles they acquired not too long ago.
Wow. A $6.1 billion impairment charge. I mean, that's not just noise. That's a massive red flag. It screams quality of earnings skepticism, doesn't it?
Precisely. It specifically fuels skepticism that maybe the company overpaid for those Karuna assets. And that undercuts faith in management's ability to execute future M&A wisely, which, let's be clear, they absolutely need to do for pipeline replacement down the road. Investors start worrying they're spending billions on assets that might not actually pan out as expected.
Okay, so you've got the cliff, you've got accounting weirdness, then we have the external factor, the debt pile colliding with the macro picture.
Overhang 3. Balance sheet and macro pressure. You nailed it. Net debt ballooned up to around $41 billion after those successive bolt-on acquisitions. And crucially, higher real interest rates increased the discount rate used in all those financial models, the WACC, the weighted average cost of capital. And that disproportionately slashes the present value of those very long-dated pipeline cash flows we were talking about.
Let me just translate that quickly for the listener. Higher interest rates basically kill the value today of earnings that you hope to get, say, 10 years from now. It makes that post-2028 cash flow vacuum look exponentially worse in today's valuation. It's a classic duration risk problem, amplified.
Exactly right. And finally, there's a fourth overhang. The whole pharmaceutical sector is kind of suffering from style rotation in the market.
Overhang 4. Sector-wide derating. Makes sense. Capital has flowed aggressively out of these defensive high cash flow pharma stocks like BMY, right? It's been chasing non-pharma growth thinking AI, obviously, and the big GLP-1 weight loss drug names. And this sector rotation has just left traditional pharma stocks like BMY sitting at multi-decade valuation discounts relative to the broader market.
So yeah, the core synthesis here seems pretty clear when you look at all the pieces. The disconnect isn't really disbelief in management's operational competency. I mean, the sources suggest they're crushing the execution side quarter after quarter. It seems to be purely a spreadsheet problem. It's defined by the sheer size of that 2028 cash flow vacuum and the proof gap. The market needs hard clinical proof from the new pipeline before it will truly lift that stubbornly low valuation multiple.
Okay, so let's pivot and look forward then. We know what the market hates right now. What specific events, according to our sources, over the next 12 months could potentially break this frustrating show-me stance and actually unlock the stock's value?
We can frame this using a sort of structured probability analysis based on the analyst views in the CompassScope report and similar research. The base case, the most likely scenario perhaps, has about a 50% probability. This suggests a pretty modest range-bound return for the stock, maybe somewhere between a -5% and plus 15%. In this scenario, execution continues to be good, but the key binary catalysts coming up are kind of mixed. Some hit, some miss. And that just keeps the stock stuck in show-me territory. The strong 6% dividend yield probably provides a decent floor here, though.
But the real prize everyone's watching for is the bull case. You're saying that carries roughly a 35% probability. And this implies a really significant return, maybe greater than 25%, lifting that PE multiple from, 7.4 times up towards 9 times or even more. What specifically needs to happen for that kind of multiple expansion?
Right. That bull case requires several specific hard clinical and regulatory catalysts to land successfully. It's not just about continued good execution. And the interesting thing is several of these are clustered right around the turn of the year, late 2025, early 2026. This timing could really force the market to start pricing in future growth sooner than it wants to.
Okay, let's detail that critical watch list then. What are the must-land catalysts for the next 12 months?
Catalyst 1 is very near term. Breyanzi MZL approval, that's for marginal zone lymphoma, and the PDUFA, the FDA decision deadline is December 5, 2025, very soon. This is really critical for bolstering their high-growth, high-margin cell therapy franchise. Needs to keep growing.
Okay, number 2 sounds absolutely critical, especially given the Karuna deal noise.
Yeah.
Cobenfy, ADT2.
Yes, this one is huge. This is the phase 3 data readout for Cobenfy and Alzheimer's disease psychosis. It's expected late 2025 or maybe early 2026. This first study is massive because, remember, they likely need 2 positive ADPT studies to actually file for approval in this indication. So the first one has to hit.
Right, high stakes there. And catalyst number 3.
Catalyst 3 is the TYK2 psoriatic arthritis PSA approval. The PDUFA date for that one is March 6, 2026. This is crucial because it helps validate their strategic move outside of core oncology and into the massive, very diverse immunology market. It significantly broadens and diversifies their revenue base beyond just cancer treatments, which is key post-LOE.
Okay, so let's connect the dots. If they can successfully nail, say, 2 out of those 3 major clinical or regulatory decisions, Breyanzi, Cobenfy, ADT2, and so TYK2 PSA, what's the implied upside potential for the stock?
Well, if 2 of those 3 big drug catalysts hit positively and the macro environment stays reasonably benign, for example, if the Fed starts signaling future easing, which would lower that WACC discount rate we discussed, then you could easily see multiple expansion. Lifting the PE to maybe 9x or even 10x estimated 2026 earnings seems plausible in that scenario, and that suggests a potential 30-40% upside from current levels. You'd be targeting a share price maybe in the $57 to $63 range. That potential upside, that's really what makes this whole story so compelling, despite all the risks right now. Hashtag tech outro. So I think the final takeaway is pretty clear. BMY is a classic story stock with a spreadsheet problem. Management is delivering fantastic operational execution. They're successfully mitigating the near-term patent erosion. They're proactively building that replacement pipeline through deals. However, the sheer undeniable size of that 2028 patent cliff means the market requires concrete clinical proof, actual positive trial data, not just strategic promises or good quarterly execution, before it's likely to lift that valuation multiple significantly.
Right. And that leaves us with a final provocative thought for you, the listener, to chew on. The market is clearly demanding clinical proof. We see these major catalysts clustered around Q4 2025 and Q1 2026. The question for you is this: where do you think the greater hidden risk lies? Is it the slow-motion train wreck of the looming Optivo LOE post-2028, which everyone sees coming? Or is it a potential surprise failure in one of these new, arguably more speculative indications, like Alzheimer's psychosis with Cobenfy, where the market might be embedding relatively low probabilities of success right now? Which risk worries you more? Thanks for joining us for this deep dive.
This content is produced by CompassScope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on CompassScope.com.